Welcome students to my class Accountancy Simplified for class 11. In today's class, I shall focus on basic and fundamental areas of accountancy which are very important for students like you as beginners. And at the end of the class, you will have a clear picture as to the definition of double entry system, the concept debit and credit, the definition of account and its classification, and the rules regarding debit and credit. Before I start my class, I want to share a news with my students and listeners that I am going to introduce a new book on accountancy in the name Accounting Problems, a New Approach for the students of class 11 for CBSE and ISC. The book will soon be available in the market, and I do hope the book will be warmly received by the students and teachers community of our country. So let's start our class. Before I go in details as to the definition of double entry, I once again define the definition of accountancy for better understanding of the concept double entry. What is accountancy? Accountancy is the science of recording day-to-day transaction of financial activities of any entity in an orderly manner in a set of books with a view to measure the end result, that is profit or loss of an entity, or to ascertain the value of assets and liabilities on a particular date. So it is very clear from the above definition of accountancy, the main and primary task of accountancy is to record transaction. Now what is transaction? Transaction is an event having monetary impact on the financial activities of an entity. In other words, transaction may be defined as an event which can be expressed in terms of money or money's worth. Purchase of goods for cash, cash sales of goods, purchase of furniture for cash, payment of salary to staff, payment of wages to the workers may be cited as an example of transaction. Transaction may be classified in two clubs. One is called cash transaction and the other one is called credit transaction. Under cash transaction, payment is made promptly, while in case of credit transaction, payment is deferred for a particular period of time. Now, before I go in details as to the definition of double entry, I once again quote the definition of accountancy. Accountancy is the science of recording day-to-day transaction in an orderly manner. What is that orderly manner? The orderly manner is the mode or system of recording day-to-day transaction. There is many a style and or mode of recording transaction, but amongst them, double entry system of accounting has received global recognition for its sound logic and scientific approach to recording transaction. It is a foolproof measure as it has a well-designed policy and procedures for recording transactions. Under double entry system, each and every transaction is analyzed in its two aspects, recognizing the fact that every business transaction is a twofold affair and confirming the very essential condition of transaction that it has one receiving aspect and one giving aspect. The aspect which receives benefit, we call it debit, and aspect which offers benefit, we call it credit. The basic and fundamental principle of double entry system is that for every debit there must be equal and corresponding credit. The other essentiality of transaction, that is change in the financial condition as a result of a transaction, can be seen if we take the example of purchase of furniture for cash for rupees 10,000. As a result of this, there is an increase of rupees 10,000 in furniture aspect and there is a reduction of rupees 10,000 in cash aspects to prove the authenticity of double entry system. Now, what are the basic features of this system? Under double entry system, each and every transaction is analyzed in its twofold aspects. Every transaction is divided into two parts. One is called debit and the other one is called credit. And for every debit, there is an equal and corresponding credit. These are the basic features of this system. Now, what are the advantages of this system for which we do recommend or maintain accountancy under double entry system? Under double entry system, each and every transaction is maintained in its totality under different heads of accounts. Double entry system accounting can provide to its management and owners a true picture of profitability and the status of financial assets and liabilities on a particular debt. Double entry system can ensure true and fair view of profit or loss of any entity under as it maintains each and every transaction under different heads of account. Double entry system accounting is the main principle of double entry system accounting is for every debit there must be an equal and corresponding credit, which ensures arithmetical accuracy of the books of accounts. It minimizes the chances of fraud and misappropriation of fund. Double entry system accounting enables the management and the owners to compare the financial standard and profitability of its company with the previous year and with the standard and trend of the industry as well. The government and other regulatory authorities can assess the tax liability of the companies from the financial statements as furnished by the double entry system. The lending agencies like bank and other financial institutions can sanction loans and advances to the companies on the basis of financial statements as rendered by double entry system. So these are the various advantages for which we do maintain accounts under double entry system of accounting. Now we are coming to the concept, what is debit and credit. The concept debit and credit are the key parts of double entry system. We have already seen from the definition of transaction that in every transaction there is two parts. One is receiving aspect and the other one is giving aspect. The aspect which receives benefit is called debit, and aspect which offers benefit is called credit. The word debit has its origin from the Latin word debitum, what is meant to say what is due or owed. It indicates the account receiving benefit as a result of any transaction, and it is written on the left hand side of an account. The concept credit has also its origin from the Latin word creder, which means to say to lend. It signifies the yielding of results of an account as a result of any transaction, and it is mentioned in the right hand side of an account. So this is the basic fundamental structure of this double entry system. So please concentrate on this area for better understanding of accountancy. Now we come to the definition of account. What is an account? An account is a comprehensive, precise and classified record of transactions of similar nature and taken place during a given period of time involving one person, one kind of asset or liability, or one kind of expenditure or income. Purchase of now we can classify accounts under two categories. One is personal account and other one is impersonal account. Impersonal account is further classified in two heads. One is real account and other one is nominal account. Personal account relates to persons, institutions, organizations, etc. like Ram, Sham, Jodu, Madhu, Tata India, Tata Communications, Reliance Communications, BML Limited, State Bank of India, Bandhan Bank Limited, etc. etc. These accounts relates to persons, institutions and organizations. The next one is real account. Under real account, all transactions relating to property and assets are recorded, like land, building, plant and machinery, furniture, cash in hand, computer, motor car, etc. etc. And what is nominal account? Transactions relating to expenditure, income, gains and loss are recorded under these heads of account, like purchase of goods, sales of goods, payment of salary, payment of wages, receipt of interest on fixed deposit, etc. etc. Now we are coming to the point of rules regarding debit and credit of these different three classes of accounts, which is called golden rules in accountancy. The rules regarding debit and credit under double entry is very definite and well defined. And what is that rules? That rules is in respect of personal account, which relates to transactions regarding persons. In respect of personal account, the rule is debit the receiver and credit the giver. That means if in a transaction, if any person receives any benefit out of the transactions, his account will be debited, and the person who offers benefit, his account is credited. Now, what is the golden rules regarding real account? Real account relates to property and assets. The golden rule is what comes in debit and what goes out credit. If any asset comes in, we do debit that asset account. If in any asset goes out, we do credit that account. This is the golden rules of real account. Now, what is the golden rules of nominal account? Nominal account relates to expenditure and income, gains and losses. The golden rule is debit all expenses and losses and credit all incomes and gains. So if there is an expenditure and loss, we shall debit those accounts, and if there is an income or gains, we shall credit those accounts. These are the fundamental golden rules of debit and credit in respect of all these three accounts. This is the key area of accountancy. So concentrate on this area very carefully and with all your attention. So that's all for today. And before I conclude my lecture, I once again request all my students and listeners to like and share my channel, and not to forget to click the subscribe button for greater circulation of my channel if they like it. Thank you. Goodbye.